Good afternoon, everyone. Thank you for joining us for this second program in a series presented by the Maryland State Bar Association Consumer Bankruptcy Section related to the impact of the pandemic on your practice. This program is focused on student loan and mortgage forbearance under the CARES Act. I'm Andrea Terry, the Director of Learning for the MSBA, and I'd like to thank our faculty today for putting together today's presentation. If you'd like to pose questions for faculty to answer, you can do so by typing it into the YouTube chat line, or you can email your questions to Chriselle Anderson at chriselle@msba.org, the email address that appears at the bottom of your screen. Your faculty today are Kelly Grafton with Grafton Firm, Will Grafton also with Grafton Firm, Jeff Skolnick with Silverman Thompson Slutkin and White, and Bill Steinwettel with the Legal Aid Bureau of Maryland. Bud Taman with the Consumer Bankruptcy Law section is moderating today and has helped organize this entire series as well as today's presentation. And so I will turn the program at this point over to Bud to get started.
Thank you, Andrea. It's always a pleasure to be here. We're thrilled that everyone is in attendance today. We certainly are thrilled to be here. We've put together a very informative program for you. It's a somewhat of a deceptive topic. It seems to be just a no-brainer when you think about it, the issue of forbearance, student loans, and mortgages. After you get into the program, you'll see all of the details that are discussed, and you'll realize that, as with everything else that we do, there's always more than what meets the eye. One of the main points of our program in both sections, the mortgage and the student loans, are going to be what is not included. That seems to be somewhat of a theme with the CARES Act in general. Knowing what's not included is as important as knowing what is included. That seems to be the way it works with the PPP and EIDL, and it works that way with mortgage and student loan forbearance issues. Our faculty, as Andrea has stated, in the order that they're going to be presenting, first is Bill Steinwettel, and Bill is our current Secretary of the Consumer Bankruptcy Section. He's the presumptive Vice Chair of the section. Barring some strange event before the election, he'll be the vice chair, and next year he'll be the chair, which doesn't surprise me at all. He's been very active in the section since he's been a part of it. He's been also a co-chair with me in our Ocean City programs for the last several years, and we've also done other programs together. Will and Kelly Grafton are a husband and wife team that have their own firm in Towson. They have a long-standing practice before their firm and in their firm. They do bankruptcy and commercial issues, and they deal with the mortgage forbearance subjects a lot in their practice. Jeff Skolnick is a longtime practitioner in the Baltimore metropolitan area. At various firms and in solo practice. He's currently of counsel to Silverman Thompson, and he has done many programs himself on the CARES Act, and we're happy that he's joining us in this one. This is just a very narrow area for some of the subjects he's discussed on the CARES Act. I think he told me he's done 8 webinars already, which is a lot when you think that the CARES Act is not that old. The faculty put together a very nice set of materials, which you'll get in the PowerPoint, and Robert Thomas, one of our Chapter 13 trustees, has contributed a chart which does a pretty good job of summarizing some of the mortgage forbearance issues. Robert's not in the program, but Robert is always one to contribute, whether he's personally contributing or giving materials, and that's what he did for us today. So without any further ado, I will turn the program over to Bill Steinwettel.
Thank you, Bud. Thank you, Mr. Timon, this afternoon. And also I thank the audience as the current secretary of the of the consumer bankruptcy section. I thank you for all joining us today, and I also thank you for giving me the first reason to wear a full suit since March the 13th, which I did not have. Outside of my involvement in the consumer bankruptcy section, I'm also a staff attorney with the Foreclosure Legal Assistance Project of Maryland Legal Aid. So we're facing a lot of issues in regards to the CARES Act and mortgage forbearance. But it's important for everyone in whatever area of the law that you practice in primarily to know, because people are getting this relief. And if you don't know what's currently in place or what's coming, which Mr. and Mrs. Grafton are going to talk about after I finish, then you're going to be lost. And so this is a very important topic for everyone to at least have a basic understanding on what's happening and what's going on. Bill, if you can go to the next slide. So what myself and then Mr. and Mrs. Grafton are going to be talking about afterwards is mostly focused on Section 4022B of the CARES Act, which is the one that focuses on mortgage forbearance. Basically, when the COVID-19 recession, downturn, whatever you want to term it, happened, basically Congress passed this act in late March of this year to deal with that. And one of the provisions of that was allowing people to apply with their mortgage servicers if they had a federally backed loan for a mortgage forbearance of up to 180 days, and then another extension for up to 180 days if the loss of income was directly or indirectly caused by COVID. So if you need to look at the statute, it's Section 4022B. And one of the biggest provisions, which we're going to talk about all the provisions today, but one of the biggest provisions that I want to mention that was not going to get a lot of talk today is that they're not allowed to add any additional fees, penalties, or interest if a forbearance is granted outside of what would have normally been added under a normal circumstance. So just keep that in mind. They can't add any additional penalties or interest or what have you, which a lot of times you'll see if you do, like I do a lot of bankruptcy work, you'll see mortgages put a lot of costs in. They're not permitted to do that in regards to forbearance. Same thing's true for traditional loan modification, and that's not true of this forbearance. By statute, they're not permitted to do that. Next slide. So who's eligible? This is one of the most important things. It has to be a federally backed mortgage. Now and I'm going to talk about this more later, that doesn't necessarily mean that if your client doesn't have a federally backed mortgage, that they're not going to get a forbearance. It just means that they are not legally required by the statute to be given the option of forbearance. So for those of you that do not practice in the mortgage area of the law frequently or deal with a lot of mortgages, federally backed mortgages are Fannie Mae and Freddie Mac first. They're not government agencies directly. They're what are called government sponsors entities, or GSEs. So they're basically private companies that get a lot of government funding, for lack of a better term. So they're sort of a government sponsored entity. FHA is that's the Fair Housing Administration. That is actually a government agency. The VA, that's a division of the Veterans Administration. So that actually is a government agency. And USDA, they do a lot in more rural areas, agricultural areas. But the United States Department of Agriculture, they will give loans as well, and they are also considered federally backed loans. So it's important to check if your client's loan is actually federally backed. One of the clients I had that was actually a major issue is that it appeared to be federally backed, but Fannie Mae and Freddie Mac during the last economic downturn between 2007 and 2009 suffered a lot of loss economically. So they sold off a lot of their loans as part of a restructuring process to get into a better fiscal position. So it is important to check. What this means for you is it's important to check land records, your client's documents, or calling the mortgage company yourself for your clients, or having your clients do that to see if it is a federally backed mortgage. If you can go to the next slide. So the first prong of the statute, after you get past the second prong, after you get past the federally backed mortgage prong, is you have to show that there's a COVID-19 hardship. So what that means, if you read the statute directly, is that the job loss or loss, it has to be a job loss or loss of income caused directly or indirectly by COVID-19. So that means they just have to state that the borrower has to state that, due to COVID-19, I've had my hours cut. Due to, I did Uber. Now I'm only getting 20% of the business that I got on March the 10th. You just have to be able to articulate a reason. And now it may change servicer to servicer what the requirement is. Like, do you actually need to provide documentation? But FHA has told us they are not requiring any documentation, just a statement of hardship. So if this is an FHA loan, they are telling their servicers that all you have to do is state that there is a hardship. And I use the picture of JCPenney here because, as for those of you that are not aware, JCPenney is now in Chapter 11 bankruptcy, which means they're shutting down stores, they're cutting down hours at other stores. So pretty much all of the 800, I think it's 800, 3,000, 5,000 employees of JCPenney could all apply for this COVID-19 hardship because the COVID-19 forced JCPenney into bankruptcy, which forced them to either have less hours or be laid off entirely. Next slide. So what do you have to do to apply, and how do you apply? The statute says the only thing you have to do is submit documentation, and we talked about for FHA, that's just a statement of hardship, a written proof or an affidavit explaining the hardship and how it's directly or indirectly connected to COVID-19. Again, they are not, also going back to what we had said in the what I had said in the second slide, the mortgage company is not permitted to add additional fees to the mortgage to process these applications. So they can't say, well, it's going to cost us $50 or something to process. They're not permitted to do that. The person can either apply via mail, telephone, or online in most circumstances. Online has generally been the most successful, but I know for those of us that practice bankruptcy, that can be difficult because sometimes the online access has been cut off by the servicer because of the bankruptcy. So in that situation, if you're an attorney, you may have to execute one of those letters where you give your client consent to speak to the servicer directly so they can call and apply. There are also some servicers, the two that I've had the most dealing with that have done this are Mr. Cooper and Wells Fargo, where they're just basically giving the person they're saying, you're eligible for forbearance, here you go, you're behind, here's a forbearance. And that's also okay. I mean, it's up to the servicer if that's what they want to do. But just be aware of that. Some of your clients may have already received it and really not done anything affirmative in their direction to apply for it. They just were given it. That can happen as well. Next slide. So what is the relief that you get? So you get a forbearance that lasts up to 180 days on the loan. So basically it can be, up to 180 days. That means either, 3 months, 6 months. I haven't seen anything like 2 months or 1 month. It's usually somewhere between 3 and 6. 3 has been the most common that I have seen. The thing is, according to the statute, if the hardship has continued to the end of that, you can reapply for an additional 6-month forbearance. And as long as you meet the test that it is directly or indirectly connected to COVID-19, and it is a federally backed mortgage, that means that it's okay. So I actually think as things start to get a little bit better, and I'll put that in parentheses, you may start to see people try to come up with other reasons to deny, say, well, you don't need it anymore. Well, the statute says, as long as you can show that you are still facing an economic hardship or a loss of income directly or indirectly connected to COVID-19, you can reapply for an up to 180-day extension of the original relief. So again, they cannot use the person, as long as they're continuing to have a hardship, as long as this law is in place, and we're going to talk about the sunset provisions in a second, that they can't say that they still can't have the relief. So that's something to watch out for as we move forward. Next slide. So the sunset provisions. So inside the CARES Act itself, and specific to this relief, the CARES Act is set to sunset on December 31st, 2020, or whenever the president lifts the COVID-19 emergency declaration. Which again, not being political, but the president said that we were getting close to the end of COVID-19, so that may happen before December today at his press conference. So that may be before December 31st, 2020. That's very possible. So that's important to watch out for. If you see that the president has lifted the state of emergency, then that technically, my reading of this puts an end to this bill. So that's another thing to watch out for. Next slide. So there are very few acceptable reasons to deny somebody for forbearance at this point. The first one, and that's the one I just talked about with the client I had, is it's not a federally backed loan. So it's important to check if this is still a federally backed loan. But the important thing I also want to emphasize is that is not an absolute bar. That is not an absolute bar to somebody getting a COVID-19 forbearance. Some services are still doing it as long as they can establish a direct connection or indirect connection to COVID-19 and a loss of income. So you should not dissuade your clients if they need the relief from applying for it. So please don't do that. It never hurts to try. I mean, a lot of servicers, especially ones like Wells Fargo, that have gotten a lot of bad press for a lot of other issues, are really being, forward thinking or forward giving at this point. So it's important to apply, even if your client, it is important to advise your client to apply if they need the relief, even if it is not a federally backed loan. Also, if they could technically deny it if your financial hardship predated the COVID-19 crisis, but that's where, as a lawyer, if you're involved, you can get a little bit creative. Like it could have gotten worse. I mean, it's hard to believe somebody who was already facing a hardship, it hasn't gotten worse in the last 3 to 6 months. So that would still count from my perspective. So that's important to advise your clients. Just because, well, I was already, going part-time. Well, I said, well, did you get laid off entirely? Yes. Well, that would be, it got worse because of COVID-19. So that, to me, would allow them to apply for forbearance. So it's important to think outside the box and make sure that you advise your clients to apply for the forbearance if they've suffered any kind of downturn or hardship related to COVID-19. Next slide. Unacceptable reasons to deny somebody for a forbearance. This is critical because I've gotten a lot of questions on our listserv about this. Delinquency is not a acceptable reason to deny somebody if it is a federally backed loan. Delinquency means bankruptcy, default, foreclosure. All of these reasons are not allowed. It specifically says it in the statute. Delinquency is not a reason for denial, period. It is not. Now, if the person hasn't paid their mortgage for 10 years and they apply for a forbearance, is that the one you want to challenge? Probably not, but it's still not technically a reason under the statute to deny them for forbearance. So that's very important to remember. I've heard from some people that that the servicer tells them that bankruptcy is not a reason. And what happens if the person gets a forbearance in a bankruptcy? I know a couple of my clients have gotten it already. The servicer will file a notice with the bankruptcy court, similar to the notice of mortgage payment chains and similar to other notices that they file, stating the person's in a forbearance for this long, and these are the terms. I mean, you don't even have to file a motion like you would have to if it was a loan modification in the Chapter 13. So again, there's a very streamlined process if it's in a bankruptcy. Bankruptcy is not a reason for a denial of a forbearance, period. Next slide. So what to do if your client is denied for the wrong reasons? The first thing to do is call the mortgage company. And we're going to talk about the issues with that, although they're starting to go away a little bit as things are opening up more. One thing that I've noticed over the years is almost all the mortgage companies are based out of Texas, which normally you always have to keep that in mind because it's Central Time. But in this case, it's good because Texas is opening up a little bit faster than the East Coast. So getting a hold of Wells Fargo or Mr. Cooper or other companies that are based out of Texas has actually gotten a lot easier than it was about 2 or 3 months ago. You can file a CFPB complaint. The link is on the slideshow if you've never done one before. It's a fairly simple process. Or you can advise your client to file a CFPB complaint. You can do a notice of error or qualified written request. All mortgage companies per federal law are required to post the address to send the notice of error or qualified written request for their company on their website. So it's fairly easy to find. If you don't want to do it for your clients, you can advise your clients to go to their website and they will see where to send it. And it doesn't have to be anything formal. They could just write their complaint and that will get the situation escalated in the mortgage company. And they're required by law to respond with, they're required by federal law to respond within 30 days. So the client will receive a response and hopefully that will resolve the issue. Also, if you're in a Chapter 13 bankruptcy, and that was a previous training that we had with Robert Thomas and others, you can also apply, if they were already in a confirmed Chapter 13 bankruptcy when COVID happened, they can apply for a modification that could extend the plan to up to 7 years past confirmation, which may work for your client. It may lower the payment to the point in which they can afford it. So those are all other options if your client is denied. What I did these is in sort of reverse escalatory order. I would start by calling the company, then file the CFPB complaint, or maybe do that simultaneously with a notice of error. And if I'm just exasperated and they're not going to do it, then at that point I would, if they're in a Chapter 13, I would probably see if the modification was the option. So that's how I would do it. Because this is such a new law and the law may not be around all that long, I'm not sure if any affirmative litigation would be great, because if the law sunsets, then it sort of becomes kind of a moot exercise. So at this point, I don't know if affirmative litigation, if that would a possibility. I'm not sure if that's a realistic one at this point, but that's how I would handle those situations if they were denied for the wrong reasons. Next slide. So what I've seen, it can be really slow. I had a client with Rushmore, and it was a slam dunk case. She did get it, but it took about a month and 2 months. I mean, a lot of people are, and I'm not putting this all on the mortgage companies. They never do anything real fast, generally, from my experience. But in this case, they have a lot of people applying. A lot of people are applying. They have a lot of people that are facing hardships. So, it's just like unemployment. It's sort of getting overwhelmed in a lot of ways. So that's important to remember. I always advise my clients to apply online with that disclaimer about bankruptcy, where they may be, you may have to issue a letter or something, to allow that to happen, or they have to go on the phone because they're not able to talk to the mortgage company directly. But if you can apply online, do apply online. It does move things a lot faster. This one note was more true a couple months ago, but it's still true of some servicer. It is really hard to get somebody on the phone because, again, they have fewer staff than they had before. Please keep that in mind. It's usually best to call either really early or really late when there aren't a lot of other people calling. That's usually the best time to call. Sort of in regards to the forbearances, 3 months has kind of been the rule of thumb, but I've seen as much as 6 months in some cases. So it really depends. I've seen 3 to 6 months is sort of the range that I've seen more often than not. So as I said, that's what I've seen. I mean, every servicer is a little bit different. So please keep that in mind. Now, a lot of them have an easy to access online system where you can apply for forbearance. So please look for that, or advise your clients to go there. It's pretty easy to find with a lot of cases. But again, it can be servicer to servicer. Next slide. Okay, so there is still a federal, these are things that aren't directly connected to the CARES Act, but are important to remember. There is still a federal foreclosure moratorium in place. All federally backed mortgages are not permitted to proceed with a foreclosure until after June 30th, 2020. So they can't proceed even if they wanted to. They've been told by the government, nope, you can't do it until the end of this month. Next slide. For the state, we just got the order from Judge Barbera that says foreclosures and evictions can restart on July 25th. Now, that's kind of a misnomer. July 25th is a Saturday, so it would actually be July 27th. I don't know. I think it was because of the timing of the original order. That was why it was set up that way. But it's basically July 27th. At that point, foreclosure mediations in the state can move forward if you practice in the foreclosure area. And other like notices of intent to foreclose and other things can proceed at that time. So that's important to remember. No foreclosures are going anywhere at this point. So if your client wants to apply for this relief, this is the time to do it. And the clock is ticking. Time is running out, because if it gets past July and August, they're going to start proceeding down that foreclosure road with the notice of intent to foreclose. And now you can still apply as long as the act's in place. There's nothing that says that you can. Again, delinquency is not a reason for denial. But it's important to remember, the sooner you do it, the better. The lower the default is. And I'm transitioning to my next speaker, we'll be going over in a minute or two, that the lower the default is, the easier to figure out what to do with it once you're in the position to pay again. So the earlier the better, to get the forbearance and to move forward with it. Without further ado, I think the next slide. I think the next slide is Mr. and Mrs. Grafton, Will and Kelly Grafton's presentation in the beginning. So I will turn it over to you guys moving forward at this point.
We'll turn the program over to Will and Kelly Grafton, and they're going to take the process from the application having been filed forward at this point.
All right, thank you, Bud, and thank you, Bill. So we're going to start at the end of the forbearance and what happens to the payments that were missed. You know, the options here are that there's a balloon at the end with FHA, and Fannie and Freddie have come out and said that they're not going to require lump sum payments. But again, a lot of this is being pushed to the servicers. Obviously, there's still loan modifications and repayment plans are going to be offered. But let's take a look, Bill, if you can give me the next slide. And specifically, what we're going to go through is Fannie Mae's process. Okay, so this is the information that Fannie Mae has given out to their lenders or to their servicers, and what they've told them that they require to happen. FHA, VA, USDA, they've all issued their own guidelines. They're all fairly similar. So we're going to go through Fannie. If you want to look specifically at the other agencies' guidelines, I recommend that you get the NCLC flowchart that Robert Thomas distributed on the listserv last week, and I think it's part of the materials today, and go through that. Okay. Now, to start, the forbearance is not a free ride. Okay. This is a delinquency. Okay. They're not going to be adding on late fees or interest or servicing fees, but you know, they are counting this as a delinquency. And at the end of the forbearance, if the proper repayment program isn't set, they can proceed with foreclosure. Okay, so the proper repayment, lump sum payment of the missed months, a structured repayment plan, deferral agreement, modification or refinance. Deferral agreement is probably going to be the one that gets used the most. Bill, if you can give me the next slide. Okay, so to qualify under Fannie Mae's lender letter, it's 2020-07. They released this on May 13th, but then they made some clarifications because, as usual, it was unclear from the start. It's still a little bit unclear. They're not going to determine who is eligible for a deferral until the forbearance is over. So if you get a 6-month forbearance and then you add another 6 months to it, then at the end of that year, they're going to try to determine whether or not you're eligible for a deferral. Okay, there's really only one major eligibility requirement, that the forbearance was COVID related, and that you are now able to begin making payments on your mortgage, so that your hardship under COVID-19 has lapsed. There are some very technical things that the lenders are going to be required to do, submitting, the quality right party contact to, determine the reason for the delinquency, et cetera. So the lenders are going to have to go through a lot of specific steps, but for the borrower, the goal here is that it should be easy. But we all know that that's not always how it works out. Bill, if you can give us the next slide. Okay, so when you are trying to qualify, all right, the servicer has to offer the deferral, and the borrower, all they have to do is confirm that they've resolved their hardship and can continue to make payments. Okay, the only loans that are qualified under this aspect are the conventional first lien mortgages. So fixed rate, step rate, ARMs would qualify, but a HELOC would not, or second mortgage would not. It has to be lived in. Doesn't necessarily have to be lived in by the borrower. So it doesn't have to be owner occupied. This can be applied to rental properties as well, but it can't be vacant. That the loan was not more than a month behind when the emergency hit. Okay, so that's probably a big one. So if they were due for January and February on March 1st, then they may not be eligible for deferral. And under the letter of the CARES Act, they would not be. And the loan is not more than 360 days delinquent. So again, this is where you're going to want to be very careful in advising your clients that if they were, less than 31 days delinquent on March 1st, that come the end of 12 months, they need to make one payment so that they're not more than 360 days delinquent. So you don't want to take them out a full year of forbearance if they were already a month behind. Okay. The last thing that would disqualify you is if you were already in a trial modification, a active workout or payment plan, or that your forbearance wasn't COVID related. So obviously we're talking about COVID related forbearances. So a non-COVID related forbearance would not qualify under these terms. All right, Bill, if you can give me the next slide. Okay. So this is actually a really interesting topic, the deferral terms. One of the tougher questions coming into this was what would happen to escrow advances. So you're in a forbearance and your property taxes or your water bill or your homeowner's insurance comes due and your mortgage company pays them. But that leaves them an escrow shortage. So what happens to those out-of-pocket escrow advances paid to third parties? Well, under Fannie's guidance, they are going to be put at the end of the loan, just like all of the other payments. So the principal interest would go in at the end, the out-of-pocket escrow advances, and any servicing advances. Okay. Now, the lender or the servicer is not required to pay if there's a escrow shortage coming into the forbearance. They're not required to cover that, so they can go to the borrower for that shortage. Okay, or more likely adjust next year's escrow to cover for that shortage, but they wouldn't be allowed to use the forbearance related escrow shortage to increase next year's escrow. So again, what we typically see in bankruptcy world is in the spring and fall, we generally see a lot of notices of mortgage payment changes, right? The escrow adjustments are being made. So we're going to want to look at that. We're going to want to look and see, are they taking a COVID related forbearance of an escrow advance and applying that to next year's escrow in order to increase the mortgage payment. All right, under the Fannie Mae at least has directed their servicers not to do that, and that those amounts are going to be included in the deferred payments. All right, Bill, if you want to take me to the next slide. All right. So once you get to the point where you're at the end of the forbearance, what do you do? The servicer has to offer it. Okay. But also the borrower has to accept it. So they can't just put you into a deferral. They can't just do the payment deferral. There has to be an affirmative offer and an affirmative acceptance. Okay. This one gets a little bit confusing, that they're saying that the servicer has to submit the deferral, the application for the deferral to Fannie in the same month as it determines that the borrower is eligible. So, that raises a lot of questions, but they can use an additional month to process it, but I think what they're saying is that they have to go and open the case with Fannie within that month. Now, I don't know if they mean a calendar month or if they just mean within 30 days, but again, unclear. Let's see. And the last point that needs some clarification, and I hope some comes out of this, is whether or not the deferral agreements need to be recorded in the land records. Okay. They are encouraging it, but I don't think that at this point that they're requiring that. All right, at this point, I'm going to turn it over, I believe, to Kelly, and she's going to carry us on.
All right, thanks, Will. The next question that came to my mind is, okay, what's going to happen if the borrower can't resume their full monthly payments? So Will talked about how to qualify for the deferral. And he explained that you will not be able to qualify for the deferral until the end of the forbearance period. So again, let's say you got a 6-month forbearance and then renewed it for another 6 months. So here we are a year from now. What happens if you don't qualify for the deferral because you can't resume your full monthly payments? Perhaps you've gotten back to work, but you're still underemployed, or there's still, a great financial burden from being out of work for so long. If you cannot resume full monthly payments, the servicer must evaluate the borrower for what's called a Fannie Mae Flex modification. If they're eligible, the servicer has to send an offer for this modification within 15 days after the expiration of the forbearance plan. So what's going to happen, practically speaking, is when we get towards the end of a person's forbearance period, those last 30 days, the servicer is going to be reaching out to the borrower. They're trying to get that qualified contact that they need to have. They need to make a phone call, have a conversation with the borrower and say, hey, your forbearance is about to come up. Can you afford these payments or not? If the borrower says, yep, absolutely, I can start making my full monthly payment as soon as the forbearance is over, then great. They can go into the deferral program and life is good. If the borrower says they can't, the next question is going to be, well, can you make any payments, right? Maybe your mortgage was $1,500 a month, but now you could do $1,250. Okay, well then we'll try to get you in this Fannie Mae Flex modification program. The servicer has a couple of rules on when they can and when they can't solicit somebody for this. For example, if they've already put the home into a foreclosure auction or a foreclosure sale and the date is set for the sale within 60 days, they can't solicit the borrower for this modification. But practically speaking, again, what's going to happen is this is Fannie Mae. They're going to be reaching out to the borrower towards the end of that forbearance period and say, hey, can you afford these payments or not? If they can't afford the payments, what the Flex modification option gives them is reduced eligibility criteria. So, I think we all know or can imagine how difficult it is to get a loan modification done under normal circumstances. The lenders and the servicers like to make the borrowers go through a lot of hoops and go around in circles and send a lot of documents. And then the servicer says, well, we still don't have all the documents, or we lost the documents, or we never got the documents. There's a lot that goes on for a borrower in order to apply and get accepted for a modification. The Fannie Mae Flex modification under this reduced eligibility criteria is supposed to be easier. We'll see, right? We will see what happens, but it is supposed to be easier. As long as the loan is a conventional first lien, again, like Will was saying for the deferral eligibility, the same for the modification. It can't be a home equity line of credit, can't be a second mortgage. We're talking just about first liens. The loan must not be subject to a recourse or an indemnification agreement. So if the loan was already in trouble before and there was already a recourse agreement or an indemnification agreement, it's not going to be eligible. If they already have an offer for another loan modification or another workout, then they're not going to be eligible for this Flex modification. If you want to think about it from the lender's perspective, the other types of modifications are probably more lucrative for the lender. They're probably making out better. So if there's already an offer to the borrower for another workout or another modification, that's where they have to go. Same thing if there is an approved liquidation of the loan already, or an active and performing repayment plan, a current forbearance plan, or a trial period modification plan. So basically, if you've already worked out an option or if you're already into another type of program, then you're not going to be eligible for this reduced criteria flex modification. All right, Bill, can you send us to the next slide? Okay, so the next thing I see happening is great. At the end of the forbearance period, you get the deferral, you say, yep, I can make my payments, I'm ready to go. And then you become delinquent again because something happens. We're going to be, at least this is my crystal ball, I think we're going to be in an unstable economy here for quite a while. And we're going to see lots of changes, people getting back to work, people losing their jobs again, people taking any job they can get at the end of this crisis and, you know, not being able to stay with it long term. We're going to see lots of up and downs for our borrowers. So what happens if they get into a default before they complete the deferral period? So the language used here is a little bit tricky. And I'll be honest with you, I have read through the CARES Act, I have read through Fannie Mae's lender letters, I have read through the ones from Freddie Mac, and they all use complicated language. What they're referring to here, or at least as I read it, what they're referring to here for the deferral period is essentially the length of the loan, because you don't complete the deferral period until the item that was deferred, those forborne mortgage payments, have been repaid. So that's going to get tacked on to the end of the loan, which could be 15 years, 20 years, 30, even 40 years after today. We know, based on the most recent Fannie Mae lender letter, that if the borrower becomes delinquent, more than 60 days delinquent, within that 6 months after they first get into the deferral. Okay, so let me back up to do the timeline again. They applied for forbearance, they got it for 6 months. They applied for a renewal of the forbearance, they got that for 6 months. So now we're a year down the road and they haven't made a single mortgage payment, but they've told the mortgage company they can resume their mortgage payments. Great. They applied for, got the deferral. That whole year of forborne payments is now stuck to the end of their mortgage. But then a month or two goes by and suddenly they find out they really can't afford that monthly payment and they become delinquent. So they become more than 60 days delinquent within that first 6 months of the deferral effective date. They still have the option at that point of getting into the Fannie Mae Flex modification, which would be a great alternative for a lot of borrowers. But that has to happen before the 75th day of delinquency. So in other words, that first 6 months after someone gets approved for deferral is a critical time. If they fall behind, they need to let you know, you need to let them know, however your representation is working. They're going to have a short window there between the 60th day delinquent and the 75th day delinquent to work for this flex modification. Otherwise, they're going to be, sort of stuck with the traditional options of traditional mortgage modifications, short sales, deed in lieu, whatever the option might be after that, but they're going to lose the benefit of this potential Fannie Mae Flex modification. All right, Bill, can you move us to the next? Okay, so like I said, I spent a lot of time reading through the CARES Act, reading through the lender letters for Fannie Mae, and trying to figure out a good way to flowchart it for you guys. This is what I came up with, and then shortly thereafter, Robert Thomas provided one that the National Consumer Law Center put together, which I like as well. So I'm going to show you this. And then, Bill, if it's possible to bring up the chart that Robert Thomas sent over to us, I'd like to show that next very quickly. So for me, I boiled this down into two different questions. One, did the lender or servicer get that quality right person contact that they need? This is a checkbox type thing that they have to do for regulation purposes. Basically, it means yes, they reached out to the borrower. Yes, they spoke to the borrower. Yes, the borrower confirmed that their hardship has been resolved. And yes, the borrower confirmed that they will be able to resume their monthly payments. So if all those things happen, they had that contact, the borrower says they can resume. Whether or not they were in a COVID-19 forbearance, they can actually get the COVID-19 payment deferral. is how I read the most recent Fannie Mae lender letter. Unless they can't make the mortgage payments, okay, or unless their loan is more than 12 months delinquent. Remember, Will said in the qualification section, if you're more than 360 days delinquent, you're not going to be eligible. All right, so then what? Then, if they're eligible, they can go to that flex modification with the reduced eligibility criteria. Again, this is the modification that is supposed to be easy. We'll see in a couple of months when we start processing these if it will be easy. They can get that modification with the reduced eligibility criteria unless their loan was more than 31 days delinquent when this all started, which we've dated back to March 1st, 2020. That's the date the National Emergency Declaration was made, or their loan is less than 90 days delinquent. So, if they haven't had a long enough period of delinquency, imagine that, right? They haven't had a long enough forbearance period to create a long enough delinquency, then they don't get this reduced eligibility, easy flex modification. So if they don't apply for any of those, they're not eligible for any of those, the next option is the Fannie Mae flex modification without the reduced eligibility criteria. So this is still supposed to be a little easier than a traditional modification, but it's not going to be as easy as if they met some of the previous criteria. So that's how I see the flow working, again, as the most recent lender letter has laid out, which was just issued last week. All of this could change for sure. The last option would be if the servicer did not get a hold of the borrower, so they don't have that quality right person contact. Essentially, they haven't checked the boxes that allows them regulatory wise to offer these options, then they can't do anything except the Fannie Mae flex modification without the reduced criteria. So the practical suggestion to your clients is, if towards the end of this forbearance period, you start getting phone calls from your servicer, answer them. Or if you're in an active bankruptcy and the servicer believes that they cannot speak to you because there's no authorization to contact, then get with your bankruptcy attorney to make sure that they have provided that authority so the servicer can talk to the borrower. The borrower has to have that opportunity to have that conversation with the servicer during that month of the last month of the forbearance period in order to check that box that they got the quality right person contact. Okay. So Bill, if we can bring up that NCLC chart, if possible. We've been spending a lot of time talking about what Fannie Mae is doing because, the bulk of federally backed loans are done by Fannie Mae and Freddie Mac, and they have very similar guidelines to their servicers. But there are a host of other ways to get mortgages in this country. Not everything is going to be federally backed. Not everything is going to be from Fannie and Freddie. So this chart that was put together by the National Consumer Law Center walks through different loan types. You'll see Fannie Mae at the top. It says the CARES Act applies. It gives you links to applicable guidance, which are the lender letters that we were just talking about, and the forbearance options, and then post-forbearance options that we've just talked about. Bill, if you scroll down a little bit, we'll see Freddie Mac is next. And then VA loans, I believe was after that, FHA, and we get all the way down to regular old private loans show up at the end of the chart there. And you can see that when we get all the way down to the private stuff, CARES Act doesn't apply. There's no guidance. There's no guarantee on what's going to happen now, no guarantee on what's going to happen later. So if you have a client with a regular old traditional bank issued mortgage that is not federally backed, and they're in the minority these days, but if you've got one, you're going to have to talk to the bank. You have to see what their options are, and you're going to have to read very carefully whatever documentation they give you, whatever forbearance agreement they give to your client, to read what the options are. Some of these private lenders are going to be expecting lump sum payments at the end of a forbearance period. If the CARES Act doesn't apply to them, they can certainly try. I don't know that they're going to be very successful, but I can tell you that we're already seeing lenders making the moves to get foreclosures started. We know that foreclosures can't really happen until the end of July here in Maryland, but they're making their moves. They're filing, motions to lift the stay in bankruptcy cases. They're getting their documents ready in cases where the borrower is not yet in bankruptcy. And as soon as they are allowed to file those notices of intent to foreclose or continue an existing foreclosure, they're going to. So if your client has a federally backed mortgage, they have to get a deferral or a modification or something to remedy that delinquency that they've now created from being in the forbearance period. And they've got to get on that quick. At the end of their forbearance period, they have to have a plan for how they're going to deal with that delinquency, or they're going to end up in foreclosure. Okay, so that's what we have. I think I saw a question pop up, but I lost it already. So we will come back to that.
We'll deal with questions at the end, Kelly.
We'll deal with questions at the end. All right. Well, at this point, then, thank you for taking the time to listen to us talk about the mortgage section of the program. And I think we're going to turn it over now to the student loan section of the program. So if you think mortgages were complicated, just wait. Jeff, I'll turn it to you.
Thanks, Will and Kelly. Jeff Skolnick is going to talk about the student loan deferments now.
Good afternoon. Let's see. There was a song by, can you hear me? First of all, can anybody hear me? There was a song by Alice Cooper years ago called Welcome to My Nightmare. And that would sum up very well what people are confronted with student loans and trying to maneuver through them when things are going well in the economy, let alone when things are going poorly. The CARES Act, Bud mentioned that the CARES Act, I've done a number of seminars. I did a number of seminars because I actually went home the weekend after it was signed on a Friday afternoon by the president and read the whole thing because there was nothing else to do. You couldn't go to the movies or anything like that. So you become an expert just by reading something twice and not falling asleep. After that, I was able to at least help answer questions on the payroll protection programs and on forgiveness of the money that's sent by the government as loans to various organizations, including a lot of nonprofits. But just to give you an idea, and this is what really fascinated me, the original thought was that it was going to cost $2.2 trillion. It's now down to the latest numbers of 1.8 trillion. But this is such a large bill then that this bill alone would make it in 2019 like the 8th largest economy in the world. It's that, not adding extra for as the money passes through the economy, the effects, because economists thought it would be 4.4, which would put it like in 3rd place as the largest economy. So this is like the size of a country's economy just in this one bill. It's about, I think, 3 times the size of the 2009 bill, to give you an idea as to how mammoth it really is. So I was fascinated by anything of this size because it's kind of like if you took all of the New Deal bills together and then said, okay, let's lump them all together and then create it in the stroke of a pen over the course of a couple of weeks. But anyway, if we can go to the next slide, this pretty color graph gives you the few basics that are involved. Originally, area of education, DeVos, said that you could call in or request online to have your loan deferred. The CARES Act took that away and made it really, you would have to opt in so that it was supposed to make it easier for people who were dealing with enough stress. On most federal loans, all collection actions are stayed until 9/30/20. During that time, there's no interest, no penalties will accrue. The state doesn't apply to private student loans, which I'll go into a little more detail later. Non-payment will not be reported to the credit agencies, and any payments made will be applied directly to the principal. If we can go to the next slide, please. Being excellent practitioners, you certainly would not take my word, but you would take a look at the statute itself. What is here, and I think in the next slide also, is the actual language coming from the law with the highlights showing you what this is. Interest shall not accrue. Each month of which a loan is suspended, it will be treated as if it was paid. The secretary will ensure that there's proper reporting and any payments are suspended. If we go to the next slide, please. And all collections for federal loans were suspended. Wage garnishments stopped. I've had clients who've had their tax refunds taken by the feds over their federal student loans, and that some of them have had it actually refunded to them because it was taken close enough to the time of the CARES Act. A reduction of any administrative offsets, no involuntary collection activity. Go to the next slide, please. And this is just the rest of the parts from the statute, so that you can see it directly. I don't think there's anything really urgent here, but I wanted to show it to you in its entirety. I think there's maybe another one after that. If you can go forward, please, to the next one. Next slide. There we go. Wow, that's pretty cool. Look like something on Star Trek. All right, so borrowers will be notified not later than 15 days after the enactment. They're notified that everything is suspended. So the burden was put on the government and their collectors and their agents to give notice that everything was stopped. Collections have been suspended. And then they have to provide not less than 6 notices starting in August saying, hey, we're going to start all over again at the end of the period of forbearance. So it says here that they have the option of enrolling in income-driven repayment. Just so you know what that is, because a lot of these terms you may have to deal with. Just as an aside, the reason why I started going to student loan boot camps was I was tired of the same mantra, I'm sorry, I can't do anything in bankruptcy. And what I found is that sometimes outside of bankruptcy, because unfortunately the Fourth Circuit is still living in the 19th century when it comes to this stuff, not even the 20th century, but for this topic. But there are things that can be done in various ways. So enrolling in an income-driven repayment is not a perfect answer, because if you're paying less money, then you're just kicking the can down the road to make more payments until hopefully someday there will be a change effectuated that will address these mammoth loans that people have of $100,000 and $200,000 and paying the size of mortgage payments. But the income-driven repayment, while it sounds so simple on its face, which is you would pay based on your income, is not so simple. I have a client who is just as an aside, but so you can see how this works, I have a client who is a vice principal of a school on the Eastern Shore. And when he asked them to do the income-based program, and he filled in the numbers and sent them to them, they wanted $800 to $900 a month. And he called me on the verge of a heart attack saying he couldn't do that. I know that, for example, you're not required to put in your wife's income. So when you redo the numbers, after 3.5 hours on the phone going from place to place, I finally got someone who was in charge who said to me, can your client do 900? I said, you're going the wrong way. Well, hold on a second. And she came back and she said, do you think he could do 150? Now, I don't know what happened when she put me on hold or what drugs she may have taken while she put me on hold. All I know is that she came back with 150. Now, it's not perfect because that means that interest, the size of the loan is not decreasing, it's increasing. But he has young children. He has an income that is can't be enhanced by adding hours. He's on a salary. And so for him at this moment, he was thrilled with the idea of it being 150, even though it doesn't solve all of his problems. It solves a present situation. And in fact, he's so overjoyed with it that he's making his $150 payments continuously. So he's getting at least some money off, although a small amount, albeit off the total. So that income-driven repayment plan, what I am finding is that unfortunately, when people try to do it themselves, they get some number that would cause suicide in certain people. And then for some reason, when an attorney acts on their behalf, different people, we don't get the bullpen. I get the upper echelon who have more authority to make changes. So for those of us that do this work, you can really make a difference in somebody's life when they have young children and other responsibilities. All right, so that's, if we go to the next page, please. Do you want to tear that up? There we go. All right, private student loans. If you go to the next page. The doors, yes, the theater is open. Anyway, so before I get to this, let me just explain a couple of things. Most people, if you ask them if they have private or federal loans, if it's a 50-50 chance, there's probably a 75% chance they'll get it wrong. People don't know because they're all originally from Sallie Mae and now Navient. And so people really don't know whether they have private or federal. And it's a big difference because all the regulations that allow for income-based payment schedules are adapted only to federal loans because obviously the federal government can only control those specifically. The bill that was passed, the CARES Act, obviously, once again, can only affect the federal loans and not the private loans. However, the state's attorney generals for the states listed here have made arrangements. The last two in black are more limited. Maryland is not on the list, as you can see. So, but these states have worked something out to try to create the same format for the private loans as for the federal loans, kind of work with people under the circumstances. It is true that these private loan companies are very self-conscious about the bad press they get and the concerns about unfair debt collection actions. And so because of the sensitivity, they're a little more willing at this day and age, more so than 10 years ago when I first started looking at this stuff. They're more willing to cooperate on these kind of things because they have such a horrendous image in the press and even in Congress that there's not much sympathy for them. If we go to the next one, please. Okay. And in addition to the state programs, this is a partial list of the companies, servicers that have decided to basically implement the federal CARES Act regulation for these private loans. So I know that up until like last week, I was not getting phone calls and not getting return phone calls from any of the servicers. At one point, I was getting phone calls on one case, and then I guess the guy got laid off, and so he, I guess he has to worry about his own private student loans. But in the meantime, it's something that it's something that has stopped. It's starting again a little bit, but they definitely, most of the large servicers have decided that this is not a good time to be pushing people too hard. That doesn't mean that there's not money for penalties and interest that's accruing, unlike the federal loans. It just means that some of the what we would consider to be harassment has temporarily stopped. If we go to the next slide, please. So what'll happen, the reality is, what'll happen is clients will come into your office now in the next few months. And so I try to come up with some common questions that they may have about student loans. So if we can go to the next page, please. Is my private or public? And there are some questions that you can ask to find that out, because that immediately gives you whether it's one fork in the road or whether you go to the left or you go to the right. So one question is if they know who they borrowed from. A lot of them are from Navient, but if you go to Wells Fargo's landing page or web page, there's advertisements for loans. So if they did their loans through Wells Fargo, then it's obviously private. Who did you borrow from? So once again, if it's a bank or Discover, then it's not the federal government. Who's sending you bills has something to do with that, because you can at least tell what is available or who needs to be contacted, or what the language says on the bills. Because if they're, as the C says, if they're threatening lawsuit, then it's private. Because the federal government writes, of course, the laws that benefit itself the most. And so as part of that, they do not need to bring a lawsuit. They can garnish as long as they give you sufficient time to screw up and make non-payments. So there are ways around that too, where you can rehab the loan, rehab it like it's a drunk. Your alcoholic loan can be rehabbed, and they're threatening, but if they're threatening garnishment without lawsuit, are they threatening garnishment without lawsuit? So that makes it not private, but federal. Are they offering income-based monthly payments? It's usually federal. There are some private lenders that do allow for that, but it's the exception to the rule. If they have any original loan documents, then that would be extremely helpful. And the next question is, who do you have to call or email to get these documents? What website? And fortunately, I may have an answer on the next slide. Next slide, please. Okay, so there's a website that you can go to, myfederalloan.org or studentaid.gov. You can check your paperwork. You can check your email notices from servicers or your bills. And like I said, of course, just because it says Navient or Sallie Mae doesn't mean anything. Part of the problem that people have is if they got one for each semester for 4 years, now you have 8 monsters instead of 1. So therefore, some of them can be private and some of them can be public. And federal. And some of them, I have somebody right now that she is paying on 2 of them, not knowing that was not all of them. She had no documentation. She thought the $500 a month she was paying for her daughter was very helpful. But meanwhile, this was like a 2-headed monster, and the other head wasn't collecting. She didn't even know they existed until they filed suit against her. And you may have a mix of the federal and the private. Track the loan numbers. What notices do you receive from your loans as a result of COVID? I mean, if you're having your tax returns taken, it's clearly federal. If you're having your, like I said, wages garnished or without a without any lawsuit, then that is federal. And now that they're getting notices, hopefully, during this COVID time, it'll be a little bit easier to at least track it, because people come to me that have not received anything in 2 or 3 years. Now, at least there'll be some recent documentation, hopefully, that you can ask them about. And if they've received it, it's probably federal. So that would be another thing. I think that's all I have. Is there anything else, Bill, that we have? No. So I think I've exhausted my time. I probably have exhausted your patience. Thank you for listening. Oh.
We're gonna go to questions now. My Google document seems to be missing now, Bill, so I'm gonna have to get it again. This one's a question for Will Grafton. The question is, who are the third parties Mr. Grafton was talking about out-of-pocket escrow advances to third parties regarding the amounts deferred? Who, Will, you were referring to property taxes, homeowners insurance, etc. Who are the third parties that you were referring to?
Well, we're referring to the insurance companies, the county tax assessor, et cetera, the people that the mortgage company pays the money out to. So any money that they outlay to anyone other than themselves or the borrower is a outlay of to a third party.
Okay. That's actually the only question we have. Does anyone else want to send in any questions? We're in the question and answer part right now, and we can handle some of them. We've only gotten one question. Bill Hall, I'm in a place now where I'm stuck on the Google document, so I can't get back to the program, at least to see what's going on. But it sounds like our program has now come to a conclusion. And I'd like to thank our panelists. Everybody did a great job on it, and as I think it bared out what I said earlier. There's a lot of details here that you just wouldn't think about, and it's possible that you may be leaving the program with questions that you didn't even know you had. The last page of the materials has the participants and their email addresses. That it's their contact information. You can, contact them and ask them questions about things that they spoke about. There was a lot of information given today, and I'm sure that if you're like me, you'll think about it after the program is over and realize that you do have a question. But we're here to answer them. Even beyond today. So we appreciate you being here. I do want to point out there's going to be more of these COVID-19 webinars. There's 2 that are in the process right now. They haven't been finalized yet, so we don't have a date for them, but they'll be coming out soon. And then we'd like to continue doing them. So, and frankly, if anyone has any ideas that they would like to submit for COVID-19 bankruptcy issue programs, we're all ears. You can send those to me at btayman, Tayman, btayman@taymanlaw.com. And I also want to say that Jeff Skolnick will be doing a brown bag presentation on student loan issues, which will be more in depth and a little bit different subject matter. That brown bag is going to be on September 25th. It'll either be remote or live, depending on where we are in the pandemic at that time. I'd like to thank all of you for attending. I'd like to thank our participants for contributing their time, and we'll look forward to the next one. Thank you.